Nifty future opened near previous day's value high, so it was an acceptance of higher value by market participants. But right after open, it went below the open and tested low of this thick congested profile structure. Also, there were questions regarding whether it was a failed auction, but it wasn't. First, we haven't had created a morning range yet and it was very early part of the opening session. Also, even if we consider our opening range timer from is small, we can clearly see there are more than one TPO below initial opening range. Same is also holds true on upside. This is not an auction failure on upside either. In auction failure there is always one single timer from above or below opening range, and it falls back within the range. I have made rough drawing which explains correct and incorrect auction failure. In first frame, it is a correct auction failure as price went right through initial balance and reversed back without spending much time. In second frame we can see price spent some time there, below opening range and then reversed back within the range. Therefore, that wasn't an auction failure. So moving on, let's look at the order flow. On order flow chart we can clearly see that there wasn't any active selling as it was probing the lows. Only issue we hadn't that was the case throughout the day, and it was passive sellers. On average greater than 22% passive sellers tend to affect prices more. So in order to go upside that percentage needed to be reduced. We can see red line which indicates passive sellers, and it was climbing up, an indication of passive sellers are decreasing. Here we had first responsive selling, which pushed auction right in the value area. At this time we had kept our reference line just below this demand-dominated zone, and it went right through it. For more aggressive traders when profile was extending up so quickly, it is a better idea to keep valued high as reference level. If there's enough strength in the market, price rarely goes below valued high. Problem with this approach is, sometimes after that brief retracement price tend to go up, so we end up trading more. Like I said, it is for aggressive traders. Few traders consider this as 80% rule as well. If we just forget the theory and can concentrate on the core concept, then basic principle behind this is the same. Core principle is when price enter at value high brackets and start attracting sellers, it tend to go right through all value area to reach value low. Here, again my rough drawing for your pleasure. Price went through value high at previous bracket and reached value low. Previous bracket could be previous day or present day. Mostly these are previous days, but here in our case it created small balance in first 2 hours, tied to extend up and reverse back below value high and reach value low. Breakout was clean here, as aggressive buyers pushed auction up no problem. Now let's see what happens next. As we can see it made a new high, but there was no rise in active buyers at the bottom of the chart. Which means buyers didn't follow up the price on upside and auction was keep meeting supply, and big responsive order came here. This was a clear sign that auction is finding difficult to hold above valued high. Selling was very huge. Again, if we observe passive sellers were creating problem. More often than not, it is not a smooth ride when active and passive order flow are not in sync. And yes, with this sharp reversal it may sound like all bearish and all, but fact remains that price didn't went below day's low. As long as price remain within this value area bias is neutral, our reference line for tomorrow is 8,120, if it goes below that then we will be bearish or. If Nifty future managed to stay above 8,120 but attract sellers within present value area then we will go bearish at the time, which obviously depends on how auction unfolds. So that's it for now.